And for all of our self-study and on-demand attendees, this is for people that are going to be watching this program as a recording. You do need to be logged in for at least 50 minutes of viewing time. We do check these times. And you do need to pass the quiz with a 70% passing grade. The quiz is located in the handouts tab, which is right next to the volume button in the video player. There is a picture of it on the screen right now, so please take notice. That is it for me. I'm going to hand you guys back to Tony. You guys have a great webinar.
All right, thank you for that, Lisha. So good afternoon, ladies and gentlemen. It's 7 minutes after the top of the hour, so it's time to jump straight into our program. So I'm Tony Malik. I'm going to be taking you on a ride with me for the next hour or so. And the thing that I'm going to try doing with this course is I'm going to try dragging this into reality as much as I can. And the reason I think I'm going to be successful doing that is because this is not theoretical for me. This is an actual client that I was working with and actually am still working with to get all this cleaned up. So I figured that this makes for really good material to discuss with other tax practitioners. So I think this is going to be valuable for those of you who are either already in this space or trying to get into this space. So just bear in mind that at the end of the day, it's still an international tax course. And because of that, it's going to be hampered somewhat, but I'm going to try getting it to mirror real world practice as much as I can. So let's get some obligatory items out of the way really quickly. So any section references, of course, are going to be either to the Internal Revenue Code or the Treasury regulations thereunder. And of course, none of this is professional advice of any sort. It's only for educational purposes. So let's start with some history. So this client's non-compliance really began all the way back in May of 2022. So this is a literary services company based in London, and they wanted to expand into the US market. And the only advice they got at the time when they were expanding into the US market was US immigration advice. They did not seek any sort of tax advice. They didn't seek any business advice, nothing like that. And eventually what they ended up doing was this UK-based company, UK company, hired a British citizen that was living in the US at that time. And this UK person, this UK national residing here in the US, was placed on the UK company's UK payroll. So that's what happened. This person was furthering the cause of this company locally here in the US. And the company just figured that they're doing business as usual. But eventually, the owner said that, we need to figure out what we need to do from a tax perspective, from a tax compliance perspective here in the US. They started looking for someone appropriate to work with. Eventually, in July 2023, the client got referred to me, and we had an initial conversation over Zoom. And it was at that time I told them that they actually formed Nexus here at the state level, and they had a permanent establishment in international tax language for U.S. federal tax purposes. And this is a more involved issue because not only did they have corporate income tax non-compliance, but they also had payroll non-compliance and some non-tax regulatory non-compliance. So these are all things that were mentioned to them at that point. Now, something that as tax practitioners, whether we specialize in international, whether we specialize in other areas, is we want to have a sense of the broader regulatory environment in which the company is operating, because in this case, this ended up being quite important. Now, this is specific to, New York State, but the point is, be familiar with the broader regulatory environment. For example, I also have a lot of clients in Atlanta, and the Department of State equivalent over there, known as the Secretary of State, don't have this particular rule. But in New York, if a company ends up running afoul of tax laws, you can't register in New York State unless you get clearance from the New York State Department of Taxation and Finance first. And this becomes a dilemma, because the company then has to continue operating illegally until it can finally get its tax non-compliance redressed, which also becomes a problem because as we move forward, we're going to discuss this. If a client can't register, if a company can't register, it also becomes difficult for them to comply from a tax perspective, and that's something that we're going to discuss as we move forward. The point is, there's a slide that's missing on my end over here, but anyway. So let me see over here. Okay. Yeah, have an understanding of the regulatory environment wherever you are. So the first question that comes up, okay, this is a limited liability company in the UK. So what is its classification going to be here in the US? You know, limited liability company. If you're purely domestic tax practitioner, you think of it as perhaps as a disregarded entity. But when it comes to the international rules, as long as the foreign entity, its owners enjoy limited liability, is considered an association. An association under Code Section 7701 is immediately treated as a corporation. So then the next step was, all right, let's start applying for a tax ID for this, tax ID number for this company, a federal EIN. So as we're going through the form SS4, a question that deserves to be asked is this company actually does it pass muster to become a personal services corporation? Now, when I'd shown the slides to John, not very long ago, he was mentioning that, something like a talented services company wouldn't be a personal services company. And I would say, don't be too sure of that, And at the same time, I'm also going to be humble and say, Tony, don't be too sure of that either, actually. He could actually be right about this. So what I'm going to do is I'm going to tell you what happened, what conclusion was eventually drawn. I'm going to let you, come to your own inference on this one. So the reason why the PSE, the Personal Services Corporation classification is important because the Tax Cuts and Jobs Act did not completely eliminate all the distinguishing features of a personal services corporation. Now, you'll remember that prior to the TCJA, there actually was some pretty substantial differences between a regular corporation and a PSC, whereby a PSC was taxed, I believe, on a flat 35% rate versus a regular corporation that was taxed at graduated tax rates. That feature, that distinguishing feature has now been eliminated. But one of the things that still stands, that's still on the books, is that personal services corporations cannot have a fiscal year. Now, the issue was the UK company itself was not on a Gregorian calendar year. Their fiscal year ran from April 1st to March 31st. So in case this ended up being a personal services corporation, this company would end up getting a mismatched fiscal year, from here in the US then versus what they have in the UK. And this complicates the accounting a little bit. So that's just one of the things that came up. So normally, when we talk about a foreign corporation, we don't think of a foreign corporation as a personal services corporation, but it can be, because if you take a look into the rules for that govern PSCs, it basically says that any corporation which is not an S corporation is a C corporation for purposes of PSC determination. So this could possibly be a personal services corporation. So let's take a look at personal services. Of course, there's more that goes into it, what are the owners doing and everything, but focusing, narrowly on what the company is doing. So personal services for this purpose includes services in the fields of health, law, engineering, architecture, accounting, actuarial science, performing arts, or consulting. And consulting is the thing that was animating my interest for this purpose. So this is how I was made to understand the business when I asked, give me, help me understand what the business does. This is basically coming straight from, the owner's email. And it was, we advise publishing and TV production companies on early drafts of fiction, nonfiction, and children's books, on which new titles to acquire rights to, either to translate and publish in their market or for adaptation to screen. At present, we have 3 publishing clients for the US market in Germany, the Netherlands, and France. So this is how I was made to understand the business. So it seems like, they're advising publishing and TV production companies. Is it a PSC? Not sure yet. So what does consulting services mean? What do they entail, for this purpose, for purposes of PSC determination? Let's take a look at, what the regulations say. So performance of personal services in the field of consulting means providing advice and counsel. It does not include other services such as sales or brokerage services or economically similar services. Whether a taxpayer performs services in the field of consulting depends on the facts and circumstances including the manner in which the taxpayer is compensated for the services. And then the regulations go on to give, 10 examples to figure out whether a company is a personal services corporation or not. So these are the ones that seem the most comparable to what the client was doing. So here's some, in one example, an economic analyst advises clients on their business activities. After analyzing economic conditions, the analyst makes recommendations to the client regarding entry into an activities in a particular industry. There's another example. The taxpayer determines a client's electronic data processing needs and makes recommendations regarding the design and implementation of data processing systems for the client. That's another example right there, consulting services. And another one, the regulations provide is the taxpayer determines a client's management and business structure needs by studying the client's organization. And based on the study, the taxpayer advises the client on changes in its structure. So these are the sorts of things that start getting into whether a company is is performing consulting for purposes of meeting the tests for a personal services corporation or not. So based on that, my determination was that this is a personal service corporation. But in retrospect, that doesn't necessarily mean that John was wrong, because if the company, it turned out, was representing the writers, then an argument could be made that this is actually, somewhat in the line of a brokerage service, a brokerage company, and therefore it's not a personal services company. This was already done and dusted by then, and it ended up making no difference, because even if it were just a regular C corporation, the regular C corporations can also have a fiscal year. And since that was already what the client had done, it ended up, not mattering in the end. But the point of mentioning that is these things need to be brought into awareness. Sometimes we need to be a little bit more imaginative. Okay. Now, when we get to redressing their noncompliance, where do we begin? Of course, the first place to start would be payroll taxes, employment tax ramifications. That's the first thing that needs to be looked at. The reason for that being, that's the order you want to follow, because the payroll tax returns eventually, constitute the ingredients that go into the corporate tax return. So that would be the appropriate starting point. So this employee, by virtue of living here in the U.S. and working here in the U.S., was earning U.S. source income under Code Section 861. These are the sourcing rules, the income sourcing rules, as to whether income is foreign source or whether it's U.S. source. So in other words, if this employee is earning U.S. source income, then that UK company is paying this employee U.S. source income. So this means that the UK company should have registered for payroll tax purposes here in the US and was supposed to issue a Form W-2 and everything like that. And none of that was done. And these are just the, payroll tax laws that get implicated in this situation. Now, a thing that, that catches a lot of people off guard, especially if they're not big in the international space, is, the worldwide reach of U.S. payroll tax laws, can really shock some people. And, there's very, very few exceptions, at least that I'm aware of, in this space. So the situation, let's discuss the exceptions, and then, based on that, I'll make a comment. So limited traveler exception, right in Code Section 861. And this is a situation if you have a non-resident alien who is in the States for less than 91 days, earns no more than $3,000, and performs services for a foreign person, that's not engaged in a U.S. trade or business. And the foreign person could be, foreign partnership, foreign corporation, it could be a foreign individual. So if that's the case, then they have not earned U.S. source income in that case. If it ends up being that they can't benefit from, the limited traveler exception in Code Section 861A3, then perhaps you can turn toward a tax treaty if a tax treaty is available. And in that case, you would take a look at the income from employment or the dependent personal services articles in the relevant tax treaty to see if it could be a situation whereby this income can escape the classification as U.S. source. So, these are two exceptions. Now, I want to talk about the limited traveler exception right here, because, $3,000 is not a lot of money. Now, who knows when this statute was enacted, but these days, an employee can earn that much in a day, especially if they're a high-flying executive, let's say, and, they've been, sent to the US to, just for a day, perhaps, to attend a couple of meetings that are going to be pretty consequential for the meeting. Perhaps the argument can be made that, a chunk of their salary attributable to, their time here in the US ends up amounting to more than $3,000. And in that case, the company was, technically supposed to register here for payroll and, have the person set up for payroll and eventually file the Form 941 or what have you. So this can really, trip up a lot of people. I suspect there's quite a bit of non-compliance, when it comes to this particular matter. And the issue is, even if a taxpayer ends up qualifying for one of these very, very narrowly crafted exceptions, they may not necessarily have relief at the state level. At the state level, they may still have nexus for payroll purposes. That's very possible, right? So you just keep that in mind. You always want to do the full analysis, as to what the client's obligations are, what the taxpayer's obligations are, what should it do. And another thing that should be mentioned is not just payroll taxes. At the state level, particularly state and local level, it could also be non-tax obligations, regulatory obligations that also come into play. We'll talk a little bit about that as well as we move ahead. So anyway, Paycheck is a great company. By the way, I'm not criticizing the company at all. I'm just trying to be matter of fact about this. But the first thing that we tried doing was, we referred the client over to Paychecks. Now, what happened is they refused to do any delinquent returns. They said, they can help the client on a prospective basis, but they refused to do any of the delinquent returns. So we ended up setting them up with another company who does payroll, and actually they specialize in helping taxpayers with delinquent payroll issues. Cleanup job is what they specialize in. So they're a pleasure to work with. And if anybody wants their name, by the way, I'm happy to give it. Just reach out to me later. So payroll returns start getting worked on. Eventually, the delinquent federal returns were filed, but for New York purposes, they were entered into the voluntary disclosure program. So at least they're not going to get barraged by late payment penalty, late filing and late payment penalty. They'd be responsible for interest at the end of it all, but at least they wouldn't be, hit with all those penalties for late filing and payment. Now, for federal purposes, there is no appropriate, I should say, no suitable voluntary disclosure for this payroll purpose. So they were just filed outside of an amnesty. And, the taxpayer was told that, you're going to get notices later and, we'll help you deal with them, help you make sense of them, and, help you figure out how to make an informed decision on that score. But let's cross that bridge when we get to it. Now, while all this was happening, this is earlier I had mentioned that, regulatory non-compliance interacts with with tax non-compliance, because what happened is it turns into this very serious chicken and egg problem, because New York State wouldn't allow the company to register, and because of that, they were not able to open up a U.S. bank account. So even after the returns were done, they didn't have any way to pay their payroll taxes. So they were trying to figure this out. They were trying to make something work, but everything seemed to be a little bit difficult. So what the client eventually ended up doing was they had their U.S. employee just basically write the checks on her personal bank account to remit payment for all these payroll returns, and then the company would just reimburse her. Now, this, of course, is going to complicate the financial accounting on the UK side. But the bigger issue is that, a question that should be asked is, does the employee create personal liability by paying taxes on behalf of the company? Can the IRS potentially hold this person responsible for trust fund recovery penalty collection purposes? Thing is, yeah, it's a possible thing. I would say it's highly improbable. it would be a very serious contrivance on the part of the IRS to try going down that path, especially when the client is doing whatever they can in good faith to comply. But it's still something, that should be in your awareness, and perhaps, actually, I shouldn't say perhaps, it should be discussed with the client, just to keep them aware of some of these things. All right, so after the payroll returns here are done in the US, the delinquent payroll returns, of course, the UK payroll now needs to be amended because this person initially was on UK payroll, and they have their own system of social insurance taxes and everything, and then a refund had to be claimed over there for all these. And of course, this also means that the financials had to probably be restated somehow. Then the next thing is we have to start looking toward getting them into compliance for corporate income tax purposes. And for that, we needed the books, and this is a UK company, so they have, their activities on a worldwide basis, but then the chartered accountant in the UK, and by the way, chartered accountant is basically the equivalent of a certified public accountant here in the US. So the chartered accountant was basically advised that, not the worldwide financials that you have for the company as they are. We need you to segregate the US activities, just the US income and deductions that are attributable to the US. That's what we need for purposes of lodging the US tax returns. At the time, my thinking was that the 2022, 2023 returns, these are already late at that time, but my thinking was that we'll get all this done such that the 2024 tax return won't have to be extended. We'll get all this in time. But because it took quite some time to get the financials, we ended up getting the 2024 corporate tax returns on extension. But eventually we ended up getting the books. Now, for corporate income tax, this is New York specific, but you should know about this, especially if you have a multi-jurisdictional practice. These days, most people do. We're not quite, parochial tax practitioners anymore. Clients come from everywhere. So for New York City is interesting because New York City has its own specific, corporate income tax that it levies on companies that are doing business in New York City. And not payroll, by the way. For payroll, you're just dealing with New York State. But for city, when it comes to corporate income taxes, you're also dealing with New York City. And New York City has its own specific tax return that companies are supposed to file. So once again, this client was entered into the voluntary disclosure program, both for purposes of New York State and for New York City. And then the federal forms 1120F, they were, again, no appropriate program for this. So they were filed outside of an amnesty, but the taxes for the state and city, they were filed under the protection of the voluntary disclosure program for purposes of both state and city. Now, one thing that I want to mention is when you're entering, if you end up ever getting into a situation where you're entering a client into the joint New York State and New York City voluntary disclosure program, you want to time the client's participation in this, because what happened is for New York State takes its sweet time in getting back. They take about 75 days before an auditor gets assigned to the case. And that was my expectation that, it'll be a couple of months before, anybody gets back and, starts asking questions. But interestingly, curiously enough, the auditor from the New York City Department of Finance got back roughly 30 days later and was saying, Mr. Malik, I'm calling about so-and-so, this client that you're representing. I said, yes, how may I help you? He said, I need to know what the estimated taxes are going to be. I was like, we're not there yet. He was like, no, I need to know right now. I was like, well, I don't even have the books for those right now. So anyways, I told him that I wasn't anticipating you getting in touch so quickly. So I told him that let me get in touch with the chartered accountant over there and try getting the books. And based on that, we can have actually a productive conversation on this score. So he was happy. He left. I put in a call to the chartered accountant. Now, he was saying that he can't get the books right now because he's slammed with work. So eventually the auditor from the New York City Department of Finance gets back in touch. He's like, Mr. Malik, I need an answer on this. I was like, I don't know what to tell you. I don't have the financials for this. Now, you said something very interesting, very curious. He said, just give me any number. Like, I mean, like off the top of your head. I was like, how can I give you something off the top of my head? I can't do that. And so he then explained to me how things work on his end, that he was saying it's just sitting on his desk and he needs something from me. He needs some sort of representation before he can push it over to his manager and get this approved. And I was hesitant, reluctant to give any answer. So then, eventually he was saying, okay, let's just say for now it's zero, that this company's not going to have any tax liability for New York City corporate franchise tax purposes. And let me get this approved. And I was like, you're saying that. So anyways, that was the end of it. The good news is this ended up being auspicious because the client was cleared to enter the voluntary disclosure program for New York City Department of Finance purposes. And eventually we got the returns done. So this is really important. Just excuse me. This is really, really important. And this is not relevant to the client, by the way, but you should know about this. I mean, if you're going to start dipping your toes in this area. Foreign corporations are denied deductions and credits if the Form 1120-F is filed 18 months after the due date. Okay. Now, this client ended up not having the situation because they were able to file their tax return in the nick of time. Okay. And this is regulation section 882-4. And again, it's 18 months after the due date. So the regular due date for the 2022 Form 1120-F was April 18, 2023 under Code Section 6072. It was April 18th because, as you can already imagine, April 15th fell on a weekend. So what is 18 months after the due date? So the deadline for purposes of Section 882C2 ended up being October 18, 2024, 18 months after April 18, 2023. Now, this client's return was filed on September 30th of 2024, so right in the nick of time, so at least they did not have this nightmare to contend with eventually. And the client is blissfully unaware of this. I didn't even mention this to the client, that this is a problem they could have. Now, eventually they did get notices, okay? It was not a picnic. I mean, they got, late filing and late penalty notices, and we're going to get to that. But this is the far bigger problem. And a tip that I want to give you is that if you ever have a client that ends up blowing the deadline for purposes of Section 882C2, then take a look into the filing deadline waiver procedures, because, I've given you the citations both for the Internal Revenue Manual and also the regulation section itself. And basically what these filing deadline waiver procedures say is, in case a taxpayer is in that predicament whereby they can have their deductions denied, then you can make an appeal to the IRS to have the filing deadline waived, which effectively means that they can enjoy the benefits of claiming those deductions. That's what that is. Again, not relevant to this client, but something worth mentioning for you lot. Okay, so the returns are filed. What happens next? Let's get into it. The client was just barraged on the federal level with quarterly payroll penalty and interest notices. Actually, not just quarterly. I mean, there's also Form 941. As you can imagine, clients, a lot of times, they have, notions of fairness and everything, and they're very understandable, from their perspective. And, I can sympathize and empathize with the client because they're trying to do the right thing. They're trying to show up. They're voluntarily complying. So it's only natural, I imagine, for them to say that, it's not fair, so we want to challenge these penalties. Our job as, international tax advisors is, just let them know what's happening and then help them make an informed decision that they can go to sleep with at night. So I told them, you have the option of challenging these notices, but, these days, because, the IRS has become so, for lack of a better word, anemic, even if you challenge a penalty, then, it keeps generating all these notices that, the IRS needs additional time to respond, additional 60 days, additional 60 days to respond. So you can imagine this can really start unhinging a client after a little while. And, they let some of the loftier ideas eventually go that, about justice and fairness and everything. And they were just saying that, we want to just pay this and get on with our life because this is really sucking up a lot of our bandwidth. And, it's, detracting, from running the business, and we're dealing with this stuff, which is not that important. I can understand the client's position over there. So, this is really the appreciable benefit of, these amnesty programs. I mean, it really help, because those constant notices aren't going to be coming in. I mean, it can really make life easier for the client because they're not going to be under distress when notices from the government are coming in. So I think that's truly the benefit of some of these programs. So that's what's happening there. What happened after the corporate tax returns were filed, after the federal and the New York State? Well, I've already mentioned for New York City and New York State, they were in the amnesty program, the voluntary disclosure program, so they just were responsible just for interest. The interest notices came in, they paid them quickly, it was done and dusted after that. But if you think about it, this goes back to, it's so much easier for a client if they just do things the right way the first time, get proper advice, do things the right way, than do things haphazardly, and then, subsequently trying to fix things. I mean, it's exponentially more difficult doing things. Because now that the corporate tax returns were done, I mean, this probably meant that the financials had to be restated. And, even if that doesn't mean that the books in the UK, I mean, even if they're not going to be completely redone, they still have to be trued up or something. I mean, the chartered accountant over there has to do something, make notes in his work papers. I mean, something has to be done. And then secondly, the UK corporate tax returns have to be done because they have to claim a foreign tax credit for whatever US taxes this company was responsible for. So it ends up being a lot more work. It ends up, not being, twice the amount of work. It ends up being literally 4 or 5 times the amount of work that the business then has to do just in order to clean things up. So unfortunately, a lot of times clients just learn the hard way, but, it's, we're here to help them, All right. So in the background, there was also some non-tax compliance issues that needed to be redressed while this was happening. Now, one of the first things that, I wanted to mention was, if you'll remember, I had mentioned that the New York State Department of State wouldn't let this company register. They said you need to get consent from the New York State Department of Taxation first, Department of Taxation and Finance first. So a application was filed to get that consent. Eventually, that consent came back, and then the company was able to register in the U.S. And the thought was, okay, now we can move toward opening up a bank account. Now the next issue is some other non-tax regulatory issues that come up is that the New York Workers' Compensation Board penalize a client like $8,500 for not maintaining the required workers' compensation, paid family leave, and workers' compensation insurance. So they penalize them. Now, eventually, those penalties got redacted to roughly about $500, and the client very happily paid them. And the point of mentioning this is really, as tax practitioners, we pick up some skills that are highly transferable. They're, the letter that was basically sent to the New York State Workers' Compensation Board was very, very similar in structure, at least, to what would go to the IRS when you're trying to have penalties abated, tax penalties. Of course, the citations are going to be different. And based on that, a letter that followed a similar structure, very similar language, very similar verbiage, the penalties got abated. So, the good thing is that a lot of the skills that we pick up are highly, they have quite a bit of utility, is what I'm trying to say. So the U.S. banking rules. So this was something that was quite stressful for the client, because the client was like, okay, we've gone through the registration process. Now let's get a bank account opened. And so the U.S.-based employee, she personally banked with Chase Bank, and she went into the Chase Bank branch with all the paperwork in hand, and she was turned away. She said that she can't open an account for this company. She was told one of the owners needs to be there. Now, one of the ways you can get around that is the U.S. employee could be given a nominee interest, like 0.0001% interest. I've seen that sometimes, in order to be able to open up a bank account. But of course, that requires some work. I mean, they probably had to hire a lawyer to redo paperwork and everything like that. So that's it's a little bit more effortful going down that path. But what the client eventually ended up doing was they opened up an online US-based account with the financial intermediary known as Wise. Now, Wise, it's not a bank, it's a financial intermediary, but based on some of the research that I did, it seems like, I mean, they're still beholden to a lot of the same banking regulations. So the fact that they were able to open up this Wise bank account, but not necessarily at the Chase branch, it suggests that perhaps this comes down to financial institutional policy rather than banking law itself. So now it was a matter of, this is something that, couldn't get to immediately. But one of the things that the client was told is you're not really set up in the best way if you intend to have a heavier footprint here in the US. Because if you have a foreign corporation transacting here in the US, I mean, that's fine as long as it's, for transitory as long as it's a transitory arrangement. It's for a limited amount of time or for, limited business that they're doing here in the US. But if they have an employee over here and the idea is that they're going to expand here into the US, then the UK company really needs to have a US-based subsidiary. And this is not only beneficial for tax purposes, it's also beneficial for just general business purposes, from liability purposes, everything. First off, from a tax perspective, the company is not going to be beholden to branch profits tax. And branch profits tax is a second layer of federal income tax in addition to the corporate income tax. So that issue goes away. So the other thing is that I already discussed that. They're going to be expanding here in the U.S. So it makes sense to have U.S. for the company to have a U.S. subsidiary over here. Now, because the parent company was already comfortable banking with Wise, they went ahead and also opened up a U.S.-based Wise online account for the U.S. company as well. Now, of course, in situations like this, you always need to get the immigration lawyer involved here because the employee that was here in the U.S., her visa was tethered to the UK company. And if she's going to be moved from the payroll of the UK company to the payroll of the US company, and again, this is all being done because we're going to withdraw the UK company from this. We don't want the IRS probing directly into the UK company. I mean, we're going to limit that to just here into the US company. So if we're going to move that company from the UK payroll to the US company's payroll, we need to make sure that we're getting all our I's dotted and T's crossed when it comes to immigration law. Especially, you don't want to run afoul of anything, particularly under the current administration. So with the blessing of the immigration lawyer, the US-based employee was moved from the payroll of the UK company to the payroll of the US company. And of course, then the contracts had to be redone with the US-based client. So that was done. Now, when the U.S. subsidiary was being formed, I reached out to an experienced attorney that I'm familiar with. We've done some work together. And I told him what the issue is. And he figured that this is something that can be handled by one of his junior associates. And this is why I'm never in favor of junior associates handling things, because a lot of things that seem to be unimportant actually can be quite consequential. So I had a Zoom call with the junior attorney, and we had a good call. I told them that this is in December of 2024, and I told them to just hold off and just wait a few days and then file the paperwork to get this organized in January, so that way you're not going to create another short year for this client. And he was like, "Oh, Tony, I get that. I told that makes a lot of sense. We'll do it in January." I'm like, "Perfect. Okay." And another thing, this is supposed to be a corporation. So, the election needs to be made. So it's not a disregarded entity, foreign owned disregarded entity. We got you, Tony. Yeah, very easy to done. Okay. After all that, yeah, Tony, we got you. Excuse me. He immediately filed the paperwork and organized the entity right there in December 2024. And then eventually, when I reached out for a copy of the Form 8832, and this is very, very close to the deadline, he had not filed it. And it ended up being that he assured me, he was like, no, we're going to file it immediately. I'm like, okay, very good. It ended up getting filed on exactly the 75th day via certified mail. And unfortunately for the client, the IRS came back and denied the client their election going all the way back to the date of inception. So I discussed this with the client. What do you want? Do you want to go back to the attorney and have them, because since they helped you with this particular piece of the puzzle, you want to go back to them and talk to them and have them work this out, help you redress this. And they said, Tony, we prefer if you just handle this. I mean, you seem to be more attentive to these issues. I was like, okay, I don't have a problem, but I do, out of professional courtesy, I can send out the attorney note real quick. They said that's fine. So anyways, a letter was sent to the IRS, and basically to have the election upheld, these are the two regulation sections that were cited. And the regulation sections are 7701-3 and 7502. So 7701-3, what does it say? This basically says that an effective date of election cannot be more than 75 days prior to the date on which Form 8832 is filed, and the 75th day is not more than 75 days. And there's some examples in the regulation that also shed additional light on this. And then Regulation 7502-1 basically affords preferential treatment to certified mail, whereby the postmark date that's stamped on the certified mail receipt serves as the date of filing, not the date on which the IRS receives everything. And based on that, the IRS acquiesced. All right. Banking problems continue then, After a while, the U.S. company was fine. Everything was hunky-dory. But then all of a sudden, the U.S. subsidiary's company got temporarily frozen. And what the UK company started doing was it started paying the US company's expenses. Now, for those of you who practice, who are tax generalists, who specialize in, domestic tax work, you already know what a mess it can create if you're commingling finances. Well, I'm going to tell you in international, this takes on an entirely new meaning and entirely more risk, because the IRS can potentially impose $25,000 penalties because they can argue that a Form 5472 was not filed. And let's discuss what Form 5472 basically is. Form 5472 is a form that needs to be filed by either foreign corporations that are transacting here in the US or US companies that are significantly owned by non-US persons if they have transactions with related parties. And if you take a look in the regulation, one of the things that is considered a reportable transaction for purposes of figuring out whether a Form 5472 is required or not is whether there has been intercompany borrowing, lending, or whether there's interest. So this is the issue that comes up. If the UK company is paying expenses on behalf of the US company, someone at the IRS can potentially say that, listen, the UK company is basically extending a loan to the US company, and there's also imputed interest issues over here, and therefore a Form 5472 was not filed. So here we go, we're going to slap on a $25,000 penalty for this. So, these are some of the dangers that come up that we want to try avoiding. So this is something that was immediately brought up to the client. As soon as I caught wind of this, I, got the owner, the US bookkeeper, and the UK chartered accountant on board, and I informed them about this, that, this is the danger that's potentially created. So they said, okay, the owners immediately started working this out with the bank, and then the UK chartered accountant and the US bookkeeper, they ended up coming up with a financial accounting solution that made this tax problem go away. And the way they ended up handling this is they treated these as capital contributions from the UK entity into the US entity, because capital contributions are outside of the purview of Code Section 6038 Cap A. Code Section 6038 Cap A is the code section that requires companies to file a Form 5472. So cap contributions do not create a Form 5472 filing obligation. So for the UK parent company, what they did was they debited investment in subsidiary, which is an asset account, they credited cash. And for the U.S. subsidiary company, they just ended up debiting cash and crediting paid-in capital. Now, another thing that I want to mention It's more of an advanced international tax issue. It's a transfer pricing issue. And what I want to say is that the Form 5472 issues don't necessarily completely go away, but this is one of those situations where you can't do that much in some situations, but these are still things that need to be dragged into awareness, and you still need to be, aware of these issues. So to get technical, the IRS, if an astute enough international tax examiner ever started looking into this, they could still probably assert, that a Form 5472 was not filed if they started taking into consideration transfer pricing issues. Now, this is too small of a company for something like that to happen, but with larger companies, this is something that happens, because the sole U.S. junior employee was probably not the only person furthering the cause of the U.S. entity. They're probably getting guidance from the two owners back in the U.K. They're getting advice and guidance. And I would not be surprised if the U.K. company owners themselves are actually directly involved, in helping the U.S. companies secure some clients here in the U.S., and that is something for which the U.S. company is actually supposed to compensate the company in the U.K. for that sort of technical and managerial support. Another issue is centralized functions. This is another transfer pricing issue that comes up because certain functions were being handled by the U.K. company, for example, marketing. The U.S. company, the employees in the U.K. company are, doing some marketing for them or did, and there's also, probably some shared software that, the employee of the U.S. company is probably using, and there's supposed to be an appropriate amount of compensation for that to the U.K. company as well. Again, this is too small of a company for an issue like this to happen, but these issues do come up in larger companies. This is way outside of the scope of this particular course, but if this goes well, if I get good enough reviews, eventually, hopefully, I'll get an invitation back from the good folks at Tax Practice Pro, and I'll do a transfer pricing course on, for micro multinationals. So anyways, all this was basically done. And then the UK company, the idea is we're withdrawing it from the US. We've segregated the US operations from the UK, and now we have to start withdrawing the UK company. So the final corporate tax returns were done. The payroll tax accounts were closed. And again, to withdraw with the New York State Department of State, you again have to get consent from the New York State Department of Taxation and Finance. And that's kind of where we are right now. We're waiting for the consent to come in. And once that's in, we're going to have this UK company completely withdrawn, exited from the US market. And the good news is the US subsidiary is steadily growing. And the idea is eventually the US-based employee is going to fully manage, she's basically going to eventually, I think, be an equity owner in the U.S. company. That's what the goal is. She's going to be fully in charge of the U.S. company, and things are going well. She's really incredible and bright woman, so things are going well over there. So, the point of this was, if you ever thought, tax practitioners, they're being hyperbolic about a client's inability to solve their own problems, let alone even identify them. This is my exhibit A. A lot of times people end up getting into tax traps because they just don't know any better, or they don't care to get the proper advice. But then, trying to do it on the back end, trying to, come clean on the back end and get a clean bill of health becomes so much more difficult. That's, end over there. And let's see, we have a few minutes, so let's see if we can take some questions here. Excuse me, Alyssa?
Yes.
Yeah, so do we have any questions?
We do have a few. Actually, there's only one there. I guess it got deleted. Okay. Sometimes they'll go back after you answer it, and I've seen people delete, but here's the one we have so far.
Oh, okay. All right. Was there no classified settlement program, classified SILGA, CSV, or voluntary settlement program that could qualify for federal payroll taxes? Yeah, I did not see anything. If anyone is aware of this, let me know. I'm not omniscient, but, based on the research that I did, there was nothing. There is the IRS's, voluntary disclosure program, but this is really not what this is meant for. Like, I mean, that is if you have criminal exposure, that's when you enter somebody in this. So, like, I mean, the most appropriate thing for them to do, based on what I was able to see, was file the federal payroll tax returns outside of any structured program, and then just deal with notices as they're coming in. And like, I mean, that's like, I mean, the only play that this company had. Okay, so hope that answers that. Anything else?
That's it for right now. Does anyone else have any other questions they'd like to submit real quick so he can address them for you? They did say in the chat they would love to do a transfer pricing course. Here's John.
Hey, Tony, let's talk for a quick second about money, because I know we all are in this for money. So we can't talk about pricing per se, but we can talk about methodology. So a lot of us like flat pricing, and it gets to be squishy to talk about money. Clearly, even though you knew at the beginning the scope of this engagement, which is get me fully compliant and abate all my penalties, how do you go about quoting it and then billing it? So clearly, I don't know, first did you say this has to be broken down like into research, compliance, abatement, or just take people through the methodology for me?
Yeah, that's a great question. So yeah, I mean, whenever you're working with, we'll take on an engagement like this. I mean, you can't give a fixed price on something like this. So, we'll start off hourly. And then once, what I've started doing is with cases like these, we'll start off hourly. And then, we'll have an engagement for hourly consulting purposes. And then as soon as we can figure out what the scope of any tax returns or anything going to be, that's done on a fixed price basis. But something like this, I mean, you're involved on an ongoing basis. And a conversation that I have with the client is, don't think of me as an accountant that you see once a year. And, like, I mean, you're done. And then come tax time, like, I mean, you see me again. I mean, that's not even the sort of clients that, like, I mean, and I end up getting. I mean, people that I get, they tend to have issues, either non-compliance, or they're fairly sophisticated families or businesses. They're transaction oriented. They need constant input on a wide variety of things. So for that, we just have a retainer at all times. So, like, I mean, we discuss issues as they come up, help them as best as we can. And then as soon as something comes up, some documents and tax paperwork need to be prepared for something like that, we can carve out and do a separate engagement for that. So that's how I found it ends up working best.
And you agree 100%, any engagement like this, the opening bell, engagement letter, whatever it needs to be. And by the way, penalty abatement is not included because you have no idea what's going to happen, right?
Right. Yeah, like, I mean, it's, I think clients, they tend to be understanding as well when they have a situation like this that, we don't know what the scope and specificity of the engagement is going to be. We don't know what we're dealing with because, yeah, even though I had, some sense of what, like, I mean, the finish line is going to look like, it's still, even for someone like me who's been doing this, for like 17, 18 years, it's still an iterative process to some extent. And, some issues, like, I mean, come up, that you're like, I hadn't thought of this, never thought about this. But yeah, this is an issue that comes up.
Well, these also aren't US-based people. I mean, if you get into a fee dispute with the guy down the street, or a guy who's a US taxpayer, there are avenues for pursuing collection. If somebody's in London, short of taking a plane ride and tracking the guy down, you may not collect. So you need to be doing this on a prepaid basis and stay ahead.
Yeah, I agree.
I said, with using the retainer, with saying, give me $5,000 and I'm going to work it off at X dollars per hour,
Right. I mean, yeah, you have to be fully transparent with the client, and when you're, hitting them up for a re-up, I mean, they have to, get an itemized invoice, and based on that, if they have any questions, like, I mean, just let them know. But like, yeah, I mean, for the most part, people are happy, like, I mean, they're getting a problem solved. Fees aren't outrageous, so, I mean, at the end of the day, everybody's happy. But yeah, I mean, if, some people ask me sometimes, what would you charge for something like this? The thing is, you really would have to be an oracle to be able to quote a price on something like this, because this is like basically 2 years of work over here. a tremendous amount of involvement, a lot of advisory work, discussing with the UK chartered accountant, discussing with the owners, discussing with the US bookkeeper, arranging this with the payroll company, communicating with the auditor. There's no way, you can estimate what your time is going to be, at least I haven't found a way, or perhaps you can quote a sufficiently high price such that, you're not going to end up losing your shirt on this, but then you lose, like the client might say, Tony, you flip your lid, we're taking our business elsewhere.
No, it's all good advice, right? Get money down, bill by the hour, stay ahead of it if you can.
Yeah.
Did somebody add a Q&A in there?
They did.
Oh.
I'm just checking if y'all saw it. It's on the screen.
John, hey, John, wonderful to hear from you. So yes, John Lane, my very good friend, John, he's asking, would you do a protective return to keep the expense deduction open once you got involved if you thought the deadline was an issue? John, I have to be honest with you, I've not dealt with that. I haven't dealt with that. Mostly what I see is the client has already pulled the deadline and no protective return was filed. That's what you see more often. Can you file a protective the way I think of protective return?
No, because you would be, unless you know what the numbers are, you'd be signing the return, and that's not true and correct.
Right.
To the best of your knowledge. So that would be a circular 230 violation, in my opinion.
Yeah, and another issue is...
Yeah, he'd get the state of California would come after him too, probably.
Yeah. And the other issue is with the protective return, if I'm remembering correctly, a protective return is basically a return to say that we don't have a U.S. trade or business here in the U.S. Based on the facts and circumstances, we're filing a return just in case if the IRS determines that we have taxable nexus here in the U.S. If we file a protective return and declare that, our determination is that we don't have U.S. nexus,
So
I'm sorry.
No, I was going to say we do those if we have a U.S. sub. And the parent is doing things that we think are kind of on the line and they really shouldn't be doing, They send corporate employees from the foreign entity over here, and we're like, you shouldn't be doing that. We talk it through, and then sometimes we'll file an 1120-F with a 0 on it. Get an EIN. The downside is you're getting an EIN for the foreign entity, so now the government knows they exist, but then you file that return with a 0, because I'm saying my foreign entity has no income and no nexus, and then sometimes if necessary you make the 86-272, right, where we're not doing anything here that would create the permanent establishment.
Yeah. So John, am I correct in thinking this, that protective return is really the benefit of that is you're filing it to tell the IRS that your determination is that you don't have a U.S. trade or business, and therefore you're not taxable here in the U.S., but you're reporting what income could potentially be U.S. And then if the IRS says, no, you do have a U.S. taxable nexus here, then they just don't hit you with penalties. They just,
You also run the statute.
You also run the statute. So those are the benefits of a protective return. Yeah. So, thanks for helping me out with that, John.
I was already here, so.
Good. Okay, ladies and gentlemen, we're 5 minutes after the top of the hour. I hope you enjoyed this. In case you have questions, afterward you've got my contact information. You can email me. Email would be the best way to get in touch with me. I've had a blast doing this. Hopefully I'll get an invitation from the good folks at Tax Practice Pro again, and we'll take you on another.
Hey, Tony, 2 quick things. You'll work with folks on a project basis. In other words, it's my client, but I need your help. I can, right? You're a nice guy. You'll do the project and not take the client.
Yeah. I mean, thanks, John. Yeah, I have those arrangements with several different firms. I mean, they'll pull me in on something for a limited scope basis. There's going to be some intercompany lending, or, there's going to be something, or, stock is going to be issued to, an employee or something like that. So yeah, for those limited scope engagements, for something like that, yeah, my inbox starts popping.
Okay. Good, super good to know, Tony. Thank you. Yes, we'll have you back. Yes, we'll talk about doing transfer pricing, because I think a lot of our colleagues are just checking that box on the 5472 and not doing what they should be doing.
Yeah.
A last reminder, join us, please. If you like the content we're delivering, if you like the international content, please consider joining us. Also, the early bird rate is still open for coming to see us in October in New York. And Tony not a speaker this year, but I think he's attending. So it'll be. You can come and meet Tony.
2027, perhaps 2027. Let's
All right. I'm good. Tony, thank you again. Lissa, thank you again.
Thank you, everybody, for attending. And we hope to see you guys tomorrow. Have a good one.